Good morning, ladies and gentlemen. My name is 𝗧𝗴𝗀, and my co-host is 𝗧𝗴𝗀, and welcome to the midweek roundtable with 𝗧𝗴𝗀 and 𝗧𝗴𝗀. It's real simple. And folks, by the way, if you want to reach out to me, real simple, support@marketgeeks.com. If you want to reach out to Jeff, it's jeff@joyofthetrade.com. We talk about a lot of stuff here. Everything here is very timely. We don't script anything at all. We just talk about what's in our head. And that's what makes this really great, because we've got a lot of experience together, over 50 years of experience together. So I highly advise you listen, pay attention, and actually take some notes, because the odds are we're going to talk about something that's going to impact your investment decisions and your life. Jeff, how are you doing today?
I'm good, Roger. How are you?
I'm doing good. How are you doing this summer? Is summer treating you okay so far? Is it getting a little too warm here?
I got the kids back in the saddle after school closed, so I'm readjusting to that, but it's okay. It's all good, man. All good. No complaints.
Good. So tell me, I know that the 4th of July weekend is coming up, and my advice to most traders is to take it easy, not to be a hero, not to jump in. This is a time to get taken. What do you make of this?
Oh my gosh. We have the lowest volume in stocks that we've had since pre-COVID. It's just like super tepid, no real enthusiasm, kind of just like day to day, what I like to call wobbling in asset prices from one sector to the next. That's why we're at all-time highs, but we're going up like a turtle from there every time. And that's a volume thing. That's an enthusiasm thing. That's non-big dollars being committed. So I always shrink my trading size by a lot in this kind of environment, because it's too random. It's too random for me.
Yeah, I always tell traders, and that's exactly it. You just put it right. I mean, right on the target. It's random. There's just so much random activity right now, especially, and what I always tell traders is this: anytime there's a day off, or there's a holiday, or there's a big week ahead, it becomes a fragmented week. And if it's a fragmented week, you're just not going to get a lot of follow through. You're not going to get a lot of, it's probably the best time to do covered calls, or to do, to do credit spreads, to do just very non-activity, because the odds are the market's going to be very non-active.
Yeah. And it's okay to not force trades. You don't have to force the situation. You could take, it's kind of like, if you look at like any type of endurance type of sports, like you're supposed to, if you're racing a car, not run it redlining it the entire race. You're supposed to pick your spots and let it cool off. And trading is kind of the same way. There are spots you need to pick off just to calm down. But I wanted to ask you, you saw the jobs number just came out this morning.
I did see the jobs number. I was just about to ask you the same thing.
What's your read on that?
Well, they were expecting 600,000, 550, somewhere in the 500 to about 1 million, which anytime they have it that broad, they have no idea where it's coming. I was actually more focused on the unemployment percentage, which I think was expected between 5.6 and 5.8. I think it came in right somewhere in that ballpark. The number was okay. My main concern was that we weren't going to see that 250,000 again or anything.
Right.
This looks... Right. When you remember, you got to look at the jobless claims and the employment levels together. You can't look at them separately, because you got to look at what.
Yeah. So it was kind of like mixed picture, right? So like they were expecting like 5.6 to 5.8. I think it came 5.9, and the non-farm payrolls, they were expecting, like you said, like 600 or something, came at like 850. So
right.
Non-farm added, but unemployment's still high. But if you look underneath the hood, there's still 7 million fewer Americans working as of this last report than pre-COVID, which is a lot, which I guess is what one of the things that the Fed's looking at is saying, we have to keep, everything like really easy accommodation because people aren't working. Right. But I'm not sure like monetary accommodation is going to get people to work. I think like as long as they're getting a free hot dog, they're going to take it.
Yeah, I don't really see anything really. I don't see that number really shrinking, Jeff, till well into the fall. I think there's going to be a lot of people taking liberties this summer, for lack of a better term.
Well, yeah, we talked about this last time. Like, everybody's expecting like everyone to just go back to work now. And it's been the opposite. It's been just like a lot of employers are having to back down from that. You must come to work, because people are just like, adios, amigo. It's been real. And then you had UBS, a massive international bank, say, no, we're adopting a hybrid model. And a lot of big, obviously tech companies have always been in that camp, but a lot of traditional companies are starting to accept the reality that, people are going to work kind of like from home a little bit and from the office a little bit, and they're going to have meetings, et cetera. I don't know.
And look, the truth is, Jeff, I think it's going to get a little more towards normality. I mean, look, we're just still getting out of it. There's talking about yesterday, as you know, I moved from California. My son still has friends in California, in Los Angeles. He was talking to them on the phone. He's here visiting me for the trip. We were eating dinner last night. He's like telling me, hey, Dad, they're requiring masks in California again because of the Delta variant. I don't know if you're aware of that or not, but yeah. So, but they're talking about closing things up again.
Yeah.
I mean, can you imagine what a slap in the face? And then in the same breath, they're saying that 98% of all the hoopla that's happening is to people who have not been vaccinated. So it's kind of like, you're going to do another closure knowing this information. That just makes zero sense at any scale.
I've been saying this since the beginning, and so have you. Like, this is a new reality, is that there's going to be this COVID is going to be part of reality. It's part of we're not going to eradicate the disease from the planet Earth. It's not going away. We haven't eradicated influenza from planet Earth, so we're not going to eradicate COVID. And there's been a flu vaccine for decades and decades and decades, and still exists. And there's going to be ramp ups and ramp downs. The key is to have it like mitigated so it's not a disaster for the broader society, so it doesn't collapse hospitals, et cetera, et cetera. If you don't want to get vaccinated, you absorb all of the risk. I look at it like if you live on coastal Florida in a massive mansion and you're 1 foot above sea level, and in Ponte Vedra Beach, there's a lot of these beautiful houses that like are sitting in very precarious situation there. And it's like, if you choose not to get any type of insurance for your house and you plop down a couple of mil, and you don't care, and that risk is on you, pal, because guess what? There are hurricanes, and they do flood, and there are wind events, and they do like wipe out like very vulnerable, non-protected coastline. And I'm not a climate alarmist by the slightest stretch of the imagination.
Oh, I know.
But I'm a proponent of like this big boy. If you're a big boy and you make your bed, you sleep in it.
Jeff, there's a term for that, a legal term for that. It's called assumption of the risk. It's like if you're going to go to a tennis game and a ball hits you in the head, or if you go to a football game and you get hit by a ball, it's just part of the risk. Game, my friend. Absolutely.
Yeah. So
it's just the way it is. So I wanted to ask you about something, and this is really bothering me. The ISM Manufacturing Index. So get this. ISM Manufacturing Index prices rose 92.1% last month, up 4.1% points, hitting its highest mark since July of 1979. Jeez. 13 straight months of price increase. Dude. Record long raw materials lead time, wide scale shortages of critical basic materials, rising commodity prices, difficulties in transportation products are continuing to affect all segments of the manufacturing economy. That's the chairman of the ISM, by the way. That's a quote from him directly.
Listen, the lowest hanging fruit trades are the ones we've been talking about.
Absolutely.
Oil, semis, but oil has come on lately. And, this is the summer of pain. This is the summer of pain for prices. And the Fed doesn't care. They're looking the other way. They're going to say, deal with it. That's your assumed risk of being part of this financial experiment that we're all undertaking. But you're looking at gasoline at $6 a gallon in California already. We got shortages. You got rolling electricity blackouts happening in the United States right now as we speak, like in New York City, when we're getting these heat waves. Out west, they have 120-degree days in Arizona. It puts tremendous pressure on the grid. There's not enough natural gas. So most of these grids, 70% of the power that powers the electric grids are coming from natural gas. There's not enough natural gas right now because of obvious reason, a lot of things, just a variety of factors, but it is what it is, man. Like, they're forcing this situation, and it is a tax on the United States. It's not going to be when it appears that it's not the only thing that's transitory. And I've kind of like, I've parsed this, I'm very analytical about this stuff. So I've parsed it. The transitory aspect, Roger, of the inflation is the rate of acceleration. it's going to continue to go up, but with massive velocity flares to the upside. That part is transitory, but coming back down to what it was, that ain't happening, Jack.
Not anytime soon. I just don't see it. It's just not on my radar, especially now. I mean, this report, it's not like this report is 6 months old or 9 months old. This is yesterday. I mean, this is now.
So now you've got OPEC sitting there, and these guys are like, woo, we've got the Fed pumping cash. We've got the economy running hot. We've got people with too much money that they don't care. We can still, they're very concerned with selling a certain amount of barrels no matter what a day. That's what they're concerned with. And so the demand is starting to come back online, and everyone's looking at them saying, well, you guys gotta, you guys have been artificially like keeping production low, which is what's causing a lot of these dislocations. Come on, guys, get back to it. And they're like, not so fast.
Right.
Like, well, we're going to kick that can the same way the Fed's like, we're not going to raise rates.
You just took the words out of my mouth.
OPEC is like, no, this is our time to eat. We're going to eat right now. And so big shock. Crude goes to $75. You're looking at these exploration companies that we've been talking about, that we've been banging the drum on, pat on the back to us. They're going up 5% a day, 3%, 5%. Devon Energy, Occidental Petroleum, Marathon, Halliburton, 𝗧𝗴𝗀�ธ์. These companies are
the usual suspects.
They're ripping, and these are low. This is what I mean when I say this is the tough tape. So you have to like isolate it to a couple of things that are really happening. And for me, that's one thing that's really happening. A thing that you've been on that is perfectly like that I wanted to ask you about, that's like played perfectly, is these semiconductors. They were lagging tech. Now they're back to leading tech. Yeah. And guess what? This last month, they were the best, one of the top 2 or 3 sectors in the entire S&P 500.
Yeah.
And growth stocks in June just crushed value, mainly because of semis. What do you think of them at this point in the cycle?
I think they're going to cool off. I think they're going to cool off with the rest of the QQQ. I think they're going to lag a little bit behind. I think we're going to see a substantial reversal of that. I think we're going to see tech. I think we're going to see another run up in the energies, in the material, in the production stocks. I think the basic material, the meat and potato stocks, as you and I like to refer to them.
I agree with you.
Yeah, I think that, and I think we're going to cool off. And one of the biggest things that's bothering me is a lot of these stocks, a lot of these like Applied Material, Micron, NVIDIA, they are ultra large cap. They've got a lot of market capitalization, and right now there is a huge imbalance. And this is not my opinion. This is just based on momentum levels. There's a huge, probably, Jeff, the biggest one I've seen in the last decade.
Wow.
Well, let me tell you why. The S&P is making all-time highs. Yep. The number of stocks trading above the 50-day moving average is at 50%. Not 60, not 70, not 80. It's at 50%. We should, if you look at the balanced S&P 500, it's sitting at the 50-day moving average right now. So this price action that we're seeing is extremely concentrated in these large cap stocks, like the FANG stocks.
Yeah.
And when you take that into account with the fact that the Nasdaq 100 it's grossly overbought, it's diverging like crazy, it's listless price action, and you started the discussion today with listless, very low volume. My swing trading systems are having a very difficult time finding picks right now. Because we're in a disjointed market environment, fragmented, disjointed.
The risk reward is also like incredibly inverted on everything. Like you're picking up pennies in front of a freight train. Like you're going to try to make 2%, but you're risking 15%.
Here's the regular trades. Here's how I look at it. Here's the rubber band. Here's the regular market. It goes back and forth, back and forth, back and forth. And this is not intended to you. I mean, I just want to give people a visual. So don't you understand this well. So the rubber band goes back and forth, back and forth, back and forth. Right now we have a market that went stretched out, and they're continuing to pull on it. They're continuing to stretch it out. So it doesn't have anywhere to go, and it needs to really consolidate before moving to the next level.
I think you're right. We need, like, that's the key word. We need a consolidation period. We need a little bit of a pullback really in the market. We need like a 5% healthy correction.
Yes.
And that'll give us another 10, 15% from there.
Yeah. But at the same time, I believe that the smaller stocks, that the Russell stocks are going to, because they've been consolidating and congesting for the last several.
That's a better looking chart.
Yes.
That's a better looking chart. IWM is a much better looking chart to me than the QQQ.
Yeah. So I'm starting to do the I'm starting to do the opposite of what I've been recommending the last month. I've been talking about going long tech. Yeah. Now I'm talking about fading tech and going long the blue chip stocks, the meat and potato stocks,
right?
And putting some money into the smaller stocks because I'm finally seeing Jeff, solar stocks trading above the 200-day moving average again for the first time. So I think we're going to see more money coming into speculative stocks out of the large cap tech stocks and into the blue chip stocks.
Let's talk speculative.
Let's do that.
Yesterday, Robinhood, they filed for their IPO. So being the dork that I am, I spent the entire afternoon reading the filing, which is for all of you guys out there that want to learn about this type of stuff. You can learn a lot about a company reading the prospectuses that they file with the SEC when they want to go public, when they want to do an issuance, a secondary offering. They show you everything. And they speak in very blunt terms. They have to identify their risks. It's really like an awesome way to learn about a company. And so Robinhood filed yesterday. And I just, if you don't mind, I'd like to share some of my takeaways from it.
Oh, I can't wait to hear it.
So interestingly, they have 17% of their last quarter. So they made $100 million. Okay. So this company had made 100 revenue, right? And 17% of it come from crypto. 17% came from crypto. 81% payment for trading data. Okay. So that's what Citadel does. Citadel pays them to know what the guys are doing that have Robinhood accounts.
Isn't that amazing?
They have 18 million users, $80 billion on their assets. The valuation for the company as it stands, what they're targeting is $40 billion. To put that in perspective, Goldman Sachs, who's been an investment bank for 100 years, I may be wrong about that, but close to it. Close enough, right?
Close enough.
75 to 100 years, something.
Close enough.
They have $120 billion market cap. So they want to be 1/3 of this. Guess how much Goldman Sachs makes a year? So Goldman Sachs top line is $40 billion.
Okay.
$40 billion. And then they have $120 billion. That's their top line.
Yeah.
They have 100. So they're about 3 times booked. So these guys are going to get they're going to get it. A $40 billion market cap. But the explosive growth, unlike making no money, but the explosive growth of this company in terms of bringing on users is almost unprecedented. So you can't really fade that. One thing that's kind of is going to be really interesting to me to watch is they're going to have, the way they're structuring the IPO is they're going to try to give shares to people that open accounts and have an account at Robinhood, right?
Right,
so 35% of the offering is going to be retail. Typically, when you have a good deal, you want that to be in the single digits. You want it to be like 7 to 10%. There's a reason for that. The reason is the institutions, the cornerstone guys in those deals, they have to sign a contract. You want to talk about diamond hands and paper hands? There's no more diamond hand than a paper contract that doesn't allow you to sell your shares. It's called a lockup for 6 months, 6 to 9 months. So this institution signed 6 to 9 months lockup agreement. They can't sell any shares. The thing could go down 80% after the IPO. They can't sell it. They got to sit. They got to wait. And the retail guys are never going to have to sign something like that. So it'll be interesting to see how the post-IPO performance of Robinhood actually is.
It will be very, very interesting. And honestly, between, as you were saying all of this, I can't stop thinking about what you said about where 80% of their money comes from.
Well, and so they, when you read the filing, it's also their biggest risk to their business, right? Because they're being investigated by Elizabeth Warren,
of course,
the Senate Finance Committee, as to their primary way they make freaking money. I don't know. For me,
that's very shady, very shady.
So something like I got an epiphany that you know, Coinbase, which is a good company, it has like magnificent earnings growth and user growth and whatever in the crypto land. They were kind of the top when they IPO'd in Bitcoin. Literally, like the week they IPO'd, Bitcoin made a high and it's like down 50% since then.
Right.
Could the Robinhood listing be a top in meme stocks and like the retail insanity in the stock market? I don't know.
The timing would coincide perfectly with it because it seems like that you know, everything has every sizzle has a shelf life.
But there's a psychological correlation to things.
I love how you put this together. See, I had no idea about this 81%. This is, in my opinion, I came
prepared, Roger. I did some homework.
No. This is very Jeff. I'm telling you, everything you're saying is very interesting. On a personal level, I'm very intrigued by this because the first thing I thought about is, boy, oh boy, that's a big surprise, you know, and that's a huge vulnerability. Whenever you see 81%. And which also
yeah, they're getting a valuation like at a huge premium to like an interactive brokers, for instance, is a company that makes a lot of money, makes billions of dollars a year, traditionally charging commissions to trade all kinds of assets and providing margin and having, you know, interest rates on that, et cetera. They're like a legit broker dealer, Interactive. Their valuation in the market right now is $28 billion. Okay. So Robinhood's coming in at like they're gonna when it all said and done, it's gonna be probably like double Interactive with a much more like vulnerable business model, in my opinion.
Now let me be a little funny here for a minute and show you the irony here. And this is the best irony I've seen in years. The name of the company is Robinhood, right? Right. They're supposed to be there for the little guy, the no commission trading, and here they are making their money. Selling intelligence from the little guy to the big guy, so the big guy can take money away from the little guy because Citadel's job is to take money from the little guy. So Robinhood actually, do you see the irony here?
I do.
Now, you can't make this up if you try.
I really want to know how much Citadel, because Citadel pays these guys like all the money they make. So I want to know how much Citadel makes on what they pay, because obviously they make a lot.
It's obviously worth it, right?
Yeah, like in a massive way.
So basically Robinhood should change their name to Sitting Sheep or sittingduck.com, right? Because that's what they're doing. I mean, look, I can't make this up.
Marie Antoinette, like let them eat.
Right?
She's like part of the ruling class.
Yeah, we won't charge you any commission, but we'll sell everything you're doing to the guy that's going to nip you in the butt and take all of your money from you. I love it. What an irony.
The peasants, they're here.
Yeah, we're gonna come here, peasant. We're gonna sell all your intelligence to the king so he can. Jeff,
you have to watch this, dude, because the model's kind of changing, right? So this like having, there's other fintech companies like 𝗧𝗴𝗀. They're out there and they just put up this whole new page. I was looking at that yesterday. They're trying to attract new customers, saying we're going to give you pre-IPO shares. You can trade in these stocks before they go public, and then you can get more. You can get an allocation when they go public. And it's like these companies have so much size and they have so much money, and they're kind of like on the fringe of Wall Street, but right in the middle of what's happening in everything, that they're kind of changing the game and forcing us to pay attention.
Yeah. But I do think there's something inherently wrong with this scenario, and I think the Fed is going to get involved to some degree. And I think what the Fed is going to do, and this is just from my legal experience, which I've never used for the right purpose over the last 27 years. I think what they may do is they may put some type of a filter, a buffer, a time buffer. In other words, you can sell this information, but it has to be certain days old or something to that effect. In other words, to sanitize it a little bit and make it a little less hot.
All of this is, excuse me, all of this is happening while the market is at all-time highs and the sun is out.
Yeah.
Wait till we have a little bit of change in atmospheric pressure, as I like to say. Wait till the environment and the regime changes a little bit. You think that these people are going to sit there, have a couple of these IPOs, do a 30%, 40% around the first day on the downside that they got a massive allocation for. There's going to be so much rumbling in Capitol Hill because everybody, the thing that politicians love to do is they love to come in after the massacre. They never do things while these things are happening. They love to come in at the end find where the anger is, point the gun at the anger, and demand that pound of flesh. And it's gonna invariably be businesses like Robinhood, 𝗧𝗴𝗀, people like that, because there's going to be instances of this thing not going out. Another risk that they had like in the fine print at the bottom of the thing, Roger, you'll love this.
Yeah.
As a lawyer, you'll love this. They settled with the SEC because they got dinged for hurting their own customers when they shut down the whole GameStop thing, right? One of the aspects of the settlement is they are not going to be allowed to raise more outside capital after this IPO till 2023. So if they have another run on their bank, if they have another like miscalculation on their margin, that could be
a huge disaster.
I really just wanted to, I'm not saying like don't buy the IPO, maybe I would trade it. I'm like trading it, but I'm just trying to like give you some of my findings, those people that watch out there, what I'm looking at
it's fascinating. No. This is wonderful news, especially
if you're looking to like invest in it for like a long term. Like these are some things to consider.
I'm going to tell you my long-term prediction. They're going to have a lot of issues down the road, and I think they're going to be bought out by another brokerage. That's my down the road, a couple of years down the road, 5, 6, 7 years down the road, possibly. That's what I think is going to. I don't think Robinhood is going to make it, because what I'm hearing and seeing right now reeks of regulatory, financial, just a bunch of cowboys. This is a cowboy. 81%. This is not a well-run company. This is a company that's trying to get somewhere, but doesn't really know where it's going yet. So that's just my opinion.
I'm with you. Yeah. But I thought it was cool.
Very cool story for
people to look at that.
I'm going to share, and I have a session, 𝗧𝗶𝗺𝗲 session in a few hours. I'm going to share this, and I'm going to tell them that I got this from you, and tell everyone to tune into our session. So I really do appreciate you giving me this information, Jeff. I hope I really do appreciate it. And you should come on 𝗧𝗶𝗺𝗲 sometimes, by the way.
I will. I will. Maybe, when I come back from vacation next, I'm going to spend some time with the family.
Beautiful.
Family and stuff,
Wonderful.
Still
this
trading,
is definitely
still trading, but like calming down all the extra commitments and stuff.
So let me tell you a pair trade that I'm talking about right now, which I'm not a big pair trade guy, but I have an interesting.
I love it.
So this is buying the equal weighted SPY, and selling the regular SPY. So basically, you're buying the.
You're thinking that it's going to unconcentrate.
I think I'm buying the RSP and selling the SPY, because the RXP is an equal weighted S&P.
I like that.
And so I think the premium is going to go equalize, and I think that it's going to come down on the upper. Basically, I'm taking advantage of what you and I discussed earlier in this video. But anyhow, do you want to talk about anything specific? You want to plug something that you got going on?
Well, I mean, you just described pair trading, and I have a great pair trading service. I have the money.
You do.
And we're always looking for these long shorts, and we don't care what the market's going to do here. It's kind of it's different. It's a difficult tape in terms of like risk reward, just being like directional betting. So it's nice to have a pair on, because it sets you up for whatever's going to come our way this summer. So check out themoneylink.com. Definitely, folks, themoneylink.com. Check it out. Jeff is great. And what I love about these, I call them checkmate trades, because it's a clean trade. It's a hedge trade. It'll protect you from volatility, from adverse moves. It'll allow you to sleep at night. Great way to trade. Very, very good strategy. And if you want to reach out to Jeff, if you have any questions about anything we discussed today, he won't bite, I promise. Jeff@joyofthetrade.com. If you want to reach out, me, support@marketgeeks.com. It's an old email. I've used it for years. Jeff, I hope you have a wonderful, wonderful weekend. Have a wonderful time with your family. Get some rest, and I will catch you next week. Bye, everyone. Have a wonderful time. Happy 4th. Happy 4th. Thank you. July. Be safe, everyone. Be safe. Don't drink and drive. Be safe and have a great time, and we'll see you all next week. Great message. Bye, guys. Bye, Jeff.